Okay, welcome friends to my third class. So today we'll be discussing about profit and loss statement. It's also known as income statement. Profit and loss statement, mainly today we'll be discussing format of the statement and the various elements included in that statement. We will see how a real prof P&L account looks like of a company. Then we will also study how profit and loss statement is related to balance sheet. What is their relation with balance sheet? Are they interlinked or are they separate? Does any change in P&L statement items affect the components of balance sheet? So these are few questions we'll have a look today. Okay. Let's start. Let's start with the format first. So this is the general format. As you can see here you will have the company name, then you will have the period. If it's FY24, that date will be mentioned that this is the P&L for the period ending 2024. Now let's look at the components. So broadly, you have income or revenue. This is basically sales, and from sales, if you less expenditure, expenditure includes cost of goods sold, and you will get gross profit. So A minus B, that is revenue, and then this cost of goods sold, and if you reduce that, you get gross profit. So again, you can see cost of goods sold is nothing but opening inventory and then how much raw materials you have purchased and other direct costs you have incurred during that year, and then how much closing inventory is left out that you will reduce. So suppose when the FY24 began, you had an opening inventory of 100, then you purchased another 50 raw materials, and then at the end, suppose you were left with only 25. So your COGS would be 150. This both you will add minus 25, that is 125. It's logically also correct, right? That you had total 150 quantity of raw material or goods, and at the end of the year you were left with just 25. So how much you have consumed? 150 minus 25, 125. So that is COGS. And when from COGS, you arrive at gross profit, so which is nothing but sales minus this COGS. Then you have an important term called operating expenses. Expenses include administrative, sales, depreciation, and amortization, and other expenses. From there, you will get operating income, which is also known as EBIT or PBIT, earnings before interest and tax, or profit before interest and tax. Then, other than operating income, if you have got some non-operating income from other sources, which can be from sale of assets or from investments you have sold, so you have got some additional money from other than business operations, then it will be called as non-operating income. Similarly, if those actions result in loss, then it will be non-operating expenses or loss. Net, you will find out the non-operating income, which is profit and income and expenses. Whatever difference you have, that will be the net non-operating income or loss. So what would be the EBT or profit before tax? EBT is profit before tax. It would be operating income plus non-operating income. Both will be added for your earnings, and from there you will deduct income tax, and finally you will have something known as net income or PAT, which is profit after tax. So this is the basic structure. And just repeat for you, you'll start with revenue, then COGS, then gross profit, then operating expenses, then depreciation, amortization, then you will have operating income, and then you will see whether they have any company has any non-operating income or expenses. You will net it out, net whatever you get, you will add to your operating income. You'll add to your operating income, and you will get PBT or earnings before tax. It's also known as EBT, earnings before tax. Then you will have income tax, and finally you will have PAT, which is known as net profit. So this is the broad structure. Now we will have a real life, P&L for you. This is the latest profit and loss statement for Coca-Cola. So you can see here the year 2024. This is 2023, 2022. So this is as on March for the year financial year 2024. So the format is almost similar. You will have operating revenues, then COGS. From that you will get gross profit. Then you can see selling, general and administrative, which is operating expenses. These are operating expenses, and then after this operating expenses you have operating income, and this is known as operational profit. From there you will see additional income, interest income they are adding, this is non-operating. Then you'll have interest expense, then you have some equity income, other income. So these are all non-operating income or expenses. And finally, if you add all these things to the operating income, you will get income before income taxes, which was PBT, profit before tax. And from profit before tax, you will have income tax deducted to finally arrive at consolidated net income, which is net profit. And they have made some adjustments. We won't go into the details of that now. So basically, they are saying net income attributable to the shareholders is $10,631 for financial year 2024. So you can see it is more around 9,000 to 10,000. Last year it was high. Now it went from 9,500 10,700. Then it dipped slightly down to 10,600. And when you divide your total net income by all shareholders, number of shares, you get net income per share, which is known as EPS, earning per share. So this is the format of Coca-Cola, and it is the latest P&L statement. Okay, so you can see how the broad structure is always similar. You will start with revenue and end with net income. So this is called this top part is called the sales part is called the top line of a company, and this net income is called bottom line of a company. And as a business, we are worried about the ultimate purpose is to create profits. So we are looking at bottom line, but for that we have to start with the top line, which is sales or revenue. Now let's look at an interesting topic, which is interrelation between P&L and balance sheet. So the question is, if there is a change in P&L item, any item of the P&L, or there is a change in the profit, or there is a loss, will that affect balance sheet? If so, how? So we will look at certain scenarios where there is change in expenses and income, expenditure and income, which will reflect in balance sheet also. Let's see how. So this is a table where you have balance sheet on the left side and P&L on the right side. Now let us just go through this balance sheet. You had equipments 8,000, cash 7,000. So total assets is 15,000. Assets is 15,000, and then liability side you have equity 10,000 and retained earnings 5,000. So total again this is 15,000. So this is a balance sheet. So we have oversimplified actually just to see how the change is taking place. So this is an oversimplified version, but still for understanding this would be sufficient. Now look at the P&L. You had revenue and sales of around 20,000, and you reduced expenditure, which is 15,000, and your net income or profit, this is 15,000. This is your earnings basically, is 5,000. Sir. So this is the present. Let's assume this is the present situation of a company. Now we have to see how changes happen and how these changes reflect in each of the statements. So you can see loss or profit shown in P&L is taken to balance sheet. Now the question is, you have got this net income. You have got this net income or earnings or profit. Now what do this profit undergo? What happens to it? What changes does it result in the balance sheet? This is always taken to the balance sheet unless you have not distributed the profit. So under liability side of balance sheet, you have this section called retained earnings, and there your profit will go. So it will be added back to your capital if you are investing and will be shown in the retained earnings. Now let's see some changes. Now what are the changes we can bring? So first change is we will increase the expenditure. We will assume that expenditure increased by 200 rupees. So you see sales is almost same, 20,000. Expenditure has gone from 15,000 to 15,200. So your expenditure increased. That means your net earnings reduced from 5,000. It has come down to 4,800. Now what is the change happening in balance sheet? Net income is 4,800. So this is taken to retained earnings as we discussed. So your retained earnings becomes 4,800, and so total liabilities also now is 14,800. If you look at the assets side, you had cash of, in the previous slide you can see you had cash of 7,000, but since you are saying that your expenditure increased, so we are assuming that that increased expenditure was met from cash. The cash is reduced by 200, and therefore again this is 14,800. So now due to increased expenditure, we can see profit reduced first. That profit is reflected as retained earnings in liabilities, that also reduced, and obviously cash was reduced when expenditure increased. So finally the balance sheet size has come down by 200. Now see, there is second change, which is decrease in expenditure by 500. That means you had sales of 20,000 same, Instead of 15,000, now your expenditure has come down to 14,500. From 15,000, it came down to 14,500. So what happens? Your profit has gone up by 500. Now from 5,000 it has become 5,500. Again, we are taking this to retained earnings. Retained earnings is increased by 500. So this liability is 15,500. So 500 additional amount has come in because of expenditure reduction. Your cash will also increase by 500. So again, this is tally. Third item, you can quickly go through. This is increase in income. So instead of expenditure, we are dealing with income part. 600 increase in sales, profit increase, retained earnings increase, cash increase. So the size of balance sheet is again changed. It has become bigger due to increased profit. And the last scenario is decrease in income. So from 20,000, this income reduced to 19,600. So profit will reduce, retained earnings will reduce, liability side, and cash will also reduce by 400. Again, balance sheet size has come down. So this is the changes and their effects on balance sheet and P&L. So quickly summarize this. Increase in expenditure, it will reduce profits and cash. A cash is asset. In balance sheet, profit will be taken from the P&L, and then it will negatively affect retained earnings, which is liability in balance sheet side. Okay. So similarly, decrease in expenditure means profits will increase, so cash will increase, and retained earnings in the liability side will increase. Decrease in income, profits reduce, cash reduced, lower retained earnings in liability also reduce. Increase in income, what will happen? Profits increase, cash goes up, liability also goes up. So both sides, assets and liabilities, will change due to change in the profits or expenditure or income in P&L statement. So that's all for now. We will see you.